We're here with Dan Schimberg, man. Let me tell you something. Well, let me tell you, from broke to millions, life, money, and real estate. And special guest Dan Schimberg. Look, Dan, I'm a huge fan. People don't know. Dan may not even know, but Dan is one of the reasons why I really start jumping into big deals. I always talk about big deals. You hear, see, BHAGs, big, hairy, audacious goals. He's the king of big, hairy, audacious goals. Everybody, Dan Schimberg. Hey, man, what made you, where are you from? What are you doing? What made you get into this? Let's just jump right into it.
Well, good morning, Mike. I always struggled in school as a young kid. I was always the class clown and never wanted to really be a follower. And so I went to school and struggled in college.
Really?
And always kind of at the bottom of the class. And when I was going to the University of Cincinnati, I always had a kind of a love for real estate. My dad had a couple 4 families growing up, so I was always cutting the lawn and fixing little stuff around his buildings. And I went to UC and I could not find a decent place to live. Everything was really, really trashy.
That was like, I hate to say it, but we were both presidents of Coreyville. That was kind of a dilapidated area. It was a nice way of saying it.
It was dilapidated, and UC was dilapidated. And these landlords were really taking advantage of the students. It was a time when information wasn't available because there was no internet.
That's
so
right.
They could just take advantage of the new, latest, and greatest students without really any repercussions.
Mm-hmm.
And so I just knew that could be done a lot better. And when I got out of the University of Cincinnati, I had to sell stereos at Stereo Lab to make a living and pay my bills. But I started rehabbing houses in and around the University of Cincinnati. And I wanted to produce a housing situation that was better than what I had the opportunity to live in.
Yeah.
That was really the roots of how I kind of got started, was my bad housing experience when I was at UC, my affinity for real estate, and then really just taking one down myself.
So you went from doing some small rehab to now putting out almost $50 million a year in developments, and you got it lined up to 2026. But you always been like if it wasn't 50, it was 20 million. So how did you convert from the rehabs to jumping into developments? Like, what was that process?
So, really from the late 80s until the late 90s, I really just spent my time accumulating real estate, single families, 2 families, 6 family apartment buildings,
right.
Always in good locations. That's the first 3 rules of real estate.
Location.
And so even if they weren't great buildings, I always focused on location. And I also tried to consolidate my locations so that they were areas where I could develop expertise.
Okay.
Very, very important. And so I would just accumulate real estate. And there were several times during that time in the early 90s and the late 90s where I got really over my skis. I grew too fast.
Mm-hmm.
I really didn't have the infrastructure to manage the bills and the receivables and the payables and the employees needed. But the point I'm making to answer your question is that I was accumulating good real estate in good locations. At some point in the late 90s, I decided, after my second brush with bankruptcy, even though I never filed ever, I should have twice. I had more.
So you almost.
I had more liabilities than assets. I was broke.
You basically broke. Matter of fact, it was amazing. I remember you sold a building that was the prime part of Coreyville, and it was like clearing the edge, like it was a game changer corner, and you sold it.
Yeah,
and it went downhill. And I was like, why in the hell did you sell it? You simply like I was broke. Like
I had to sell some buildings.
But you bought it back.
I did. And, basically what I did is accumulated a lot of small real estate.
Yeah.
And after the late 90s, I made some decisions and at that point I owned 63 buildings. I decided I was going to sell 25 buildings, and I essentially put about 40 of them on the market at various times in the first about 25 buildings. But I had an amount of money I wanted to raise and essentially put that to work in more concentrated, slightly bigger deals. And that's really kind of the leap that I made, which spanned from about 99, the recession of 99, up through about 2004.
So you've been through a couple of real estate cycles. You mentioned 99, then it was 2000 with the 9/11. Then there was the Great Recession, 2008. Now we're in COVID. How is that different? How are you managing through that?
So my son is 30, and he is now joining our business after working for another company for 10 years. And I pointed out to him, which I think is really important for everyone to understand, essentially, in the last 20 years, when he was 10 years old, when he was 20 years old, and now 30 years old, we basically had 9/11, the Great Recession, and a global pandemic. And it really doesn't matter what causes an economic slowdown. What matters is that you know they will keep coming and that you are prepared to manage through them.
Yeah.
And each of those was about 8 to 10 years apart. They were all global in nature. And the results of them are very, very close, even though one was a war, one was a global recession, and one was a global pandemic. And I think the idea is when you're growing a business and when you're managing a business, you have to know that there are economic cycles and you have to be prepared for them as they come along.
Mm-hmm. Yeah. Now, 40 years in the business?
Yeah, almost. I mean, 35 years. 35 years in the business. And it was really interesting. In the beginning, I basically wanted to be a big fish in a very small pond.
Yes, that's a good statement.
And when I was buying, I said, I don't want partners. I want to just buy these pieces, own them 100%. And there were a lot of people who wanted to invest. And I just wanted to buy my 2-family and get my 2-family paid off and just kind of have it. When I went through that transition from 99 to really 2005, at that point, raising cash at that point, I finally understood the importance of having liquidity and having real staying power. And so when I sold a lot of that real estate, I took that cash and really pulled it back to create my own liquidity, circling the wagons around me and myself and family and my own assets, and then started working with investors. And what I quickly realized is when you have perfectly aligned investors and developer, sponsor is what I call it. And you make sure your investors are aligned with your own goals.
That's right.
I was able to grow my business substantially larger, take risk off the table for myself, but at the same time, really reward our investors. And we have investors with all different kinds of priorities, and we align our deals with the different priorities of different investors. Some want cash flow, some want growth in wealth, and we make sure that we are aligning our investors up with, the expectations of that deal.
That was great you said that, aligning your investors with your goal. Because a lot of people are like, they're going out to raise capital for the first time, and let's say they get $1 million, and they just accept it, not aligning each other with goals. And I tell people all the time, look, man, if your goals aren't aligned and they don't really know what you do, it's not a good match, because you can work with people and they'll worry you to death, or they'll constantly, you won't get anything done. And partnerships are almost like marriages,
Right.
because some people look at it as just this deal, but some deals last 5, 10, 20, 30 years.
Yeah.
And so it's important to align your goal, not just accepting anybody's money.
My first question when people come to me and want to invest, my first question is, what are you trying to accomplish with your money? What are you trying to accomplish? And a lot of them don't even know.
Yeah.
They just have money and they just want to put it to work. And they don't know. And I often will drill down on that because it's a great question. Why? What are you trying to accomplish with your money? Are you trying to grow wealth? Are you trying to have it supplement other income? Are you trying to have it have a little cash flow and have it grow? Is it to shelter? Is it for tax? And that is a really, really, really important question when developers or sponsors are working and have outside investors, because that is when partnerships, like you said, can go bad or can go really, really good. And so we really work hard to align that. We have deals that we said, we put buildings on 10-year amortizations, zero cash flow for 10 years.
Yes.
But it's going to grow this asset. And then in 10 years, we can do with it what we want. And it's just going to grow wealth. And we have others who just want cash flow. They don't need to grow it a penny.
I'm just thinking about, you talk about align and sharing the same goals. Dan's partners, co-workers, have you associates, they're so aligned, they look alike. Dan, CFO, and you're one of your main investors. I swear you guys look like brothers. I mean, you can't get no more aligned than that.
Yeah.
And talking about brothers and family, you kind of went against the grain. Your dad was investing in businesses, but you went into real estate. I get it. You had a dream idea, but what pushed you more into real estate than doing businesses like your father?
Well, like I said, I was the class clown and not a good student. I also would make a lousy employee. I'm kind of a big thinker, and I don't take direction well. I mean, I really.
Yeah, I think you do.
And so the result is that I really had to kind of do something on my own.
Okay.
I am insanely entrepreneurial. And that comes with a lot of responsibility. You can't just be a loose cannon, especially when you have a family and a lot of responsibility. Yeah. And so, real estate is where I landed because I have a kind of an affinity for real estate. But everyone else in our family, went to Ivy League colleges and were successful. We have a doctor, and my sister went to Brown and then Harvard with a master's, and my brother was at Michigan and went pre-law, and they all took a very kind of traditional path, if you would. So I'm the least educated, and I'm a big advocate for education, and all of my kids are well educated, and I'm well educated, but I just didn't perform well in a formal classroom setting.
Did you envision yourself where you are today? I mean, how many units do you have now? I don't even know if that's really, you got units, developments, how many are you at now?
We have about 4,000 units. And what's interesting is all units aren't created equal.
That's right.
Our units are extraordinary. They're extraordinarily located. They're in urban cores. They're near major universities or major job locations. And so I know someone who has 10,000 units who said, I'd rather have your 4,000 than my 10,000 units. Right. And we really aren't counting. It is really just, we've grown organically. We don't have goals that I have to have 5,000 in 3 years from now. But we do have a very, very, very nice portfolio. We have a group of core investors who have agreed to that these are not for sale. We've had enormous offers on our real estate portfolio, and we are in it for the long haul. We are in it to continue to accumulate real estate and to continue to kind of enjoy the cash flow. One of our key components is that the real estate is the golden goose. And all of our investors understand that before any money is distributed, our properties will always be maintained in perfect condition.
That's right.
And we will always make sure that the real estate and the property is maintained in perfect order, because you always want to take care of the real estate. If you don't, you end up with these real estate deals that kind of spiral downward. And if you look at the deals that a lot of people are looking at, they are looking at mismanaged real estate. Mismanaged real estate has a decline in value of about 20%. Yes. And that's why you go out with investors and you can go find something, rehab it, and create 20% of value. And so mismanaged real estate is really what we go out and look for when we're looking at real estate deals other than development deals. And so maintaining that real estate has to always be the priority.
Did you? I mean, naturally, we always buy in real estate. We know it's going to grow in value. But did you think, like, especially in the Midwest, Cincinnati, we would be in a market we're in now? Like, yeah, I understand COVID, but C properties are starting to sell out 5.5 caps. Like, we always thought A properties were selling that. And matter of fact, that would only be California, New York, and Florida. What do you think? Do you think that's going to be sustainable? Or are we going to keep appreciating? Cap rates are suppressing? Or do you think the markets, some people are going to get caught and that cap rate is going to jump back up?
So cap rates in the Midwest trail the coast. We're always like I think it was Mark Twain said, if the world's coming to an end, I want to be in Cincinnati because it runs 20 years behind everyone else. And so essentially what's happened is on the coast, you saw cap rates declining faster. And all of a sudden you end up with coastal investors looking for places they can invest to get better returns. And so while California and New York were seeing 4 caps, right? Austin, Texas, Miami, Florida, out on the West Coast, Seattle. As cap rates were going down, people were looking for alternative places to invest. And I think that that's what's driven the cap rates down in Cincinnati. Look, nothing's forever. Right. Nothing's forever. Yeah. But there are no real pressures on interest rates to go up. And so, that's right. Cap rates, we look at cap rates and understand that there has to be about a 250 basis point spread between what you can borrow at and where cap rates are. And right now you can borrow at 3.5%. And so you're seeing cap rates at 5.5%, 6% in the Midwest because you still can go borrow long-term money, 3.5% to 4%. So if you have a 6%, if you have a 6 cap deal, you're still making 200 basis points on borrowed money, which is a very appropriate spread.
I don't know if this is more of a question or a statement. Is this, success and work ethic and environment, right? Like, you grew up Amberley Village, and it's pretty amazing because you grew up with Harkavy, Rosenberg, who ended up creating partner main investor of Town Property, which is another large investment apartment group developer in Cincinnati. They're all doing well. Like, I'm sure they're worth over a couple of million in doing that. Do you feel that was a reason for your success, or was it your work ethic? Because I know at times I've emailed just in the morning, 2, 3 in the morning, and next thing you know, I get a response back from you. Like, does this guy ever sleep? I mean, you're still working at it. You're going strong every day. Is it outworking people, working hard? Is it an environment? What is it? What do you think some of the secrets?
For me, it's easy. And I always have between 6 and 8 mentees from the UC Real Estate School constantly. And the only time I'll meet them is at 7 a.m. in the morning. So if students want me to be their mentor, they have to meet me at 7 a.m. So my admin who manages my calendar knows when mentees reach out to me, who I've agreed to mentor, 7 a.m. is when I meet my mentees. There are two main ingredients that are a must for people to be successful, in my opinion. And it is work and integrity, hard work ethic, and integrity. Without those two, you cannot succeed. You can cheat people for a while, but then you get kicked out of town, or you end up in jail, or you end up in problem, or your investors sue you. I've been in 63 partnerships without a single partnership lawsuit, not a single lawsuit that I've been involved in with partners out of 63. And so hard work ethic and integrity for me are the two that are going to create a successful platform. And then you have to have discipline. Discipline's the last piece. People have called me up and said, I've got a great deal of a 4-family in North College Hill. You can buy it for $10,000 and flip it to $40,000.
That's right.
I don't even go look at it, right? I don't know about North College Hill. It's not in my main core. And often we have had people who said, hey, why don't you start a vending business and then you can have vending machines in all of your own pieces. Stay focused. You only have to be really good at one thing, right? I always say quarterbacks don't need to know how to kick a field goal, right? Mm-hmm. Brain surgeons don't need to know how to fix broken bones. And the same is true with real estate. If you're going to be a hotel developer, be a hotel developer. Right. And if you're going to be a multifamily guy, be the best. Be the best at whatever you want to do. You only have to be really good at a single strategy, at a single discipline. And make sure you stay disciplined. And make sure that the locations that you're investing in are pieces that you know a lot about.
Mm-hmm. Mm-hmm. That's great. And I think I'll add one thing, because I think this, especially developer, fearlessness. Yeah. Like, because I have to say, man, you were developing. Well, first of all, people thought you were crazy when you were buying Corvette.
No question,
right?
Yeah. No
and
question.
then all of a sudden you want to start doing developments. Really didn't know how to do developments at the time, but you got to start somewhere,
right?
And even me, like, I know how to buy a multifamily, and when I would see you do a development, I'm like, what is he doing? Yeah. How are you doing that? How are you going to get these returns? Are you afraid when you do a development, or do you, even though you're afraid, you still go after it? Like, how do you overcome that fear?
Well, there's risk and reward, and greed and fear. You know, mm-hmm. those are basically the components that you have. The way we reduce risk, because now we're developing in Florida, for example, mm-hmm. and we partner with boots on the ground. If we're doing a deal that's out of my expertise, it's bigger than I'm comfortable with, it's in a location I'm not comfortable with, I must have boots on the ground. And even in Cincinnati, if I'm doing a deal that is over my skis, that I'm uncomfortable with, I partner with someone who has expertise where I don't.
That's right. And
if I'm in Florida, I brought the student housing expertise. My partner brought the Florida Tallahassee expertise. Okay. If I am partnering, if I have to build something with a podium and I never built a podium, I partner with someone who's built 20 podium buildings.
Okay.
And so that is a way for me to reduce risk. Do I reduce my reward? Yes. But the important component there is reducing your risk. I always look at what the biggest risks are in the deal and take that risk off the table by structuring the financing that way, partnering with the people who can help me reduce the risk of that deal. Really, really, really critical for people who are investing. Make sure you're investing with people who have expertise in and around where you are investing.
Well, Dan, this is great, man. I thank you so much for the show. Like I said, Dan is one of the reasons why I started doing big deals. I'll never forget. So Dan and I, not only did I watch him as I was growing up build Uptown Rentals, but we shared community council together. And I know it's Dan and Tom. What's Tom's? Tom. He built
Williams?
Great Traditions. Yeah.
Oh, Tom Humes.
Tom Hume. These guys are doing $5 million, $20 million, $100 million developments, and I'm talking to these guys, and they say, "Yeah, man, I don't think I'm gonna make the deadline to sell this condo because my contractor didn't finish, or we finished the first phase, but they didn't lease it on time,
Right.
or somebody stole copper out of my building." And I'm like, "What do you mean? You're doing a 20 million, 50?" Like, they had the same problems, except when I was done with my problem, I only made 10, 30,000. When they were done, they made $1 million to 20, $30 million. And so, but I just want to say thank you from the bottom of my heart. Thank you for taking my calls, and not even the conversations, but more just doing your thing, being a leader, taking charge, even when people are just hating. Because I don't care what you do, you're going to have haters and trolls. And Dan would just push through. And I just thank you so much. I thank you for all the conversations you shared.
Yeah.
Guys like you helped me know that was possible and it's doable. And watching you guys, we've done over 1,200 units. We have like 4 going to our 5th hotel now. So it's guys like this. I just want to tell you, Dan Schimberg, everybody, thank you so much for joining me, Dan. From Broke to Millions, Life, Money, and Real Estate, I'm Mike Ely. Like I always say, God bless you, God keep you, and may God bless you beyond your booty, but not your capacity. And remember, you're one big deal away. See you soon. Thanks, brother.